Most people are still using the last 30 years to plan the next 30 years, and that's the problem. When people think about retirement, they focus on methods, what to buy, how to allocate, which company to use, but retirement planning was never a method problem. It's an environment problem. The reason many strategies worked over the past 30 years is not because they were inherently correct. It's because they were built on a very specific and a very favorable environment. And today, that environment no longer exists. Once the environment changes, the same actions no longer produce the same results. So let's define this clearly. What exactly was that friendly old world? If you look at roughly the 1990s through the 2020s, retirement planning benefited from three structural conditions. Number one, interest rates were in a long term decline. That created a 30-year tailwind for asset prices. Second, asset prices broadly expanded. Equities grew, corrections were temporary, and rebounds were strong. Third, crises were repairable. Dot-com crash, 2008 financial crisis. Each time, massive liquidity stepped in and rebuilt the system. That's the environment where ideas like FIRE became popular. Save 25 times your expenses, withdraw 4% a year. It looked mathematically sound, but it wasn't just math. It was a product of a specific era, an era where returns stayed above inflation and downturns were quickly repaired. Fire wasn't inevitable, it was conditional. It only worked because the system allowed it to work. And underneath all of this, there was one hidden assumption: you had time. If markets dropped, you could wait. If returns were low, you could wait. Time was on your side. That assumption is now breaking. And it's not one thing, it's happening across multiple layers at the same time. Let me walk you through five structural changes. Number one, return expectations are compressing. In the past, growth covered mistakes. Even if your plan wasn't perfect, markets helped you recover. Today, with higher valuations and slower growth, that self repair mechanism is weaker. And once you start touching principle, it becomes much harder to recover. Compounding flips. Instead of working for you, it starts working against you. Second, interest rates are no longer a stabilizer. They used to move in one direction, which is down. Now they move back and forth between inflation and recession fears. And every movement impacts everything: your portfolio value, your income planning, your cost of capital. You're no longer standing on stable ground. Third, inflation is back as a structural force. It's no longer a background noise. It directly affects your life, especially healthcare and long term care. But the real danger isn't just the higher prices, it's what inflation does to your timing. It forces decisions, it compresses your ability to wait, it pushes you to act in the worst possible moments. Fourth, diversification is weakening. For decades, the model was simple: stocks go down, bonds cushion the fall. But correlations are changing. We're now seeing environments where stocks and bonds decline together. What used to be a buffer can become a simultaneous drawdown. The safety layer is thinner than people think. Fifth, longevity amplifies everything. Living longer sounds like a benefit. Financially, it's a multiplier of a risk. A 20-year retirement is one thing. A 30, 40, even 50-year retirement is a completely different system. Because over that time horizon, you're almost guaranteed to encounter multiple bad market periods. It's no longer if, it is when. Now put all five together, they point to one outcome: your margin to wait is disappearing. In the past, you could say, I'll just wait this out. Today, that's not always an option because expenses are rising, volatility is higher, and time horizons are longer. And at some point, you don't get to choose anymore. You're forced to act. And this is the real risk: not market volatility, but forced decisions. You need income. The market is down. You sell anyway. And once that happens, especially early in retirement, the damage is often irreversible. It leaves a permanent scar on the portfolio. So the real question is not, will the market go down? The real question is, when it does, do you have the ability not to act? That's why retirement planning today is no longer about maximizing growth. It's about surviving pressure. It's about structure. Can your cash flow hold? Can your expenses adjust? Do your accounts actually create separation and a buffer? And most importantly, in a bad year, can you avoid touching your core assets? Because going forward, the goal of retirement planning is not to outperform, it's to maintain control, to make sure that when the external environment is at its worst, you still have the option to not make the worst decision. Whoever can stay out of forced decisions is the one who actually has the security.